What's up guys, Donnie here. Today we're going to talk about being a first-time long-term investor. We're going to talk about the pitfalls of the stock market, how to avoid those pitfalls, and what to do instead. Please keep in mind I am not a financial advisor, so always do your own research. Now with that out of the way, let's get to it. First off, do not engage in day trading. Day trading is when you buy and sell a share on the same day in order to turn a quick profit. Day trading is risky and speculative. You end up developing bad habits and it takes way too much time. You always have to watch the stock market all day. Remember, we're long-term investors and we are new at this. So unless you're going to make this a really expensive hobby or a side hustle or something, don't do it. Stay away from penny stocks. Penny stocks are small cap companies that trade on the market from anywhere from $5 to as little as a few cents. Penny stocks are not required to show their finances to their stockholders, unlike big and medium companies, so it's notoriously hard to research. They're also very volatile and susceptible to scam and manipulation. Because they're small companies, just a handful of traders buying and selling will fluctuate the price up and down very quickly. And even if you make a lot of money, say you buy 1,000 shares and it jumps up to $3 or something, and you made $3,000, there may not be a buyer because there's so few people trading these penny stocks. And like I said earlier, they're very easy to scam and manipulate. There will be buyers that buy hundreds of thousands of shares. They will hype them up to their audience or sell ads to tell you about the next Amazon, and then they will sell it at the height of at the peak, and leaving everyone else with useless shares while they cash in on their profit from you buying it. So in general, stay away from penny stocks. Next up is options. Don't do it. It's too advanced, especially for us as new investors. I'm going to read the definition of what an option is real quick. So an option in finance, an option is a contract which conveys its owner, the holder, the right but not the obligation to buy or sell an underlying asset or instrument at a specified strike price prior to or on a specified date, depending on the form of the option. It's very confusing. I still have trouble with it. Honestly, I stay away from it. It's too costly. It's too advanced. There's buy puts, sell puts, sell calls, buy calls, strike price, covered calls. Your options depreciate over time. It's very confusing. I really just stay away from options for now, at least. If you're gonna do that, at least stay in the market for a year. Figure out how it works, and yeah, just stay away. Don't click on ads telling you that they're going to find you the next Google. They're going to scam you somehow. Either they're going to hit you with a paywall before telling you the information, or they have a stake in that stock somehow. They're, like a penny stock where they're going to drive the price up and then sell it when it's high because of your money. If you're gonna go anywhere for information, I like YouTube because there's a lot of YouTubers out there who just want to see you succeed in the stock market. And if you do use YouTube, try to find the people who have a lot of information in the background in regards to that specific stock. And don't stick with one person. If you start really liking buying a stock, look up other YouTubers who are also talking about that stock and maybe get 2 or 3 different opinions in regards to it. If they're all glowing and you see no downside, go for it. And finally, do not sell or panic when the stocks go down. When it's red, it's scary. There's a lot of fear being induced. It goes down because people are scared of losing their money. But remember, you still own that stock. And us as good investors, we do our research. We know this company is not going to go bankrupt. It's not like we're investing in a cruise line during a pandemic, right? So don't panic. I treat red days when stocks are going down as a buying opportunity so that I can buy more in that stock for the long run, because we know in the long run it's going to go high. It's going to go high. These are companies that we believe in. And this is doubly true for a stock market correction or a crash when the whole stock market goes down, and this happens to affect ETFs a lot as well because it's for the whole stock market. So that's an especially important time not to panic and sell. You could lose a lot of money, but again, like I said, you still own that stock, and these companies are not going away after the crash. They're going to be rebuilding, and then other people, everyone else knows that this is a buying opportunity. That's when the that's when they buy low and hold it for the long run. And even in 1 or 2 years, you're probably going to end up being back where you were before the crash or the correction, sometimes even as little as 1 month, which is the crazy thing about stocks, right? But always, they always go up. So unless there's a zombie outbreak or an apocalypse, in which case your money is the least of your worries, right? Just stay invested in the stock market. So what do we do as first-time long-term investors? The first step I would say is to invest in an ETF, especially an S&P 500 ETF like VOO or SPY. Personally, I like VOOG, which is the Vanguard S&P 500 Growth Index, which they like to invest in companies with growth potential. That's because I prefer companies that are still growing instead of companies that pay dividends. So if you want a set it and forget it situation, just invest in an S&P 500 ETF. Keep putting money in there monthly, every 2 weeks, whenever you get a paycheck. Make it a priority to add money into this stock and stay in the market long term. You'll see it grow like crazy. Once you grow comfortable in the stock market, you start picking out companies that you like to invest in, you add it to your portfolio. Consider using M1 Finance because you can make your own pie and adding all of those companies at different weights. Like my favorite would be Tesla, it would be a big percentage of that pie, while other companies would be smaller percentages. You can invest, I think minimum is 25, and you can have this recurring automatically. So you basically make your own ETF in which you invest in over time. And you can adjust those percentages over time so it's not always the same. Like if you like this company more and more, you can make it so that it's a bigger piece of that pie and your investment is growing proportionally the way you want it to be. So there you have it, what to do and what not to do in the stock market as a new first-time long-term investor. Don't do day trading, don't do penny stocks, don't do options, don't take people's advice without doing your own research. Do not sell, do not panic sell. Always invest over time, do ETFs, and use red days as a buying opportunity. If you found this video helpful, I would appreciate a like and a subscribe. It would really help me out. Also, check out the links down below. Robinhood get 1 free stock when you sign up. Webull get 4 free stocks worth up to $1,600 when you deposit $100. And M1 Finance will give you a $10 credit when you deposit $100 or more. Thank you so much, and we'll see you in the next video. Bye-bye. And you can adjust those percentages over time so that it's not heavily weighted. What the f*** doing, man?